Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This is all my own original authentic work, as I think you deserve to have that. So with that, New York coffee. You can easily see from the action over September and October that the high at 429.5 from February this year continues to cap rises since. On the downside, the lows in September ended up being just ahead of the key 50% Fibonacci line for the important November 24 to February 25 move at 335.15. And back then it had the pierced but unbroken assistance of the mauve medium moving average, currently 355.15. A moving average that showed up again late 2 weeks ago. In truth, apart from that dip 2 Fridays ago, we seem to have built a small base since late September on top of the gold long moving average. It's currently 358.15. All these earlier actions higher left us with a number of interesting situations. Thus, I eventually drew and finessed the dark blue bearish mid-September to late October bearish shift pitchfork, which does fit, for now at least, and which you can see on my daily chart. In this, the market today is a little above the slowly declining dark blue middle time, currently at 363 even, and testing the green short medium moving average. Has punched through it just now actually, which is currently at 373.60, but it's not yet stabilized properly above it. There is something else I'd like once more to look at here, and for this I'm indebted to Ray Bradbury for asking me about New York coffee 35 weeks ago, and I went at the time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on the monthly longer term charts, I noticed back then a pattern that had not been immediately obvious to me at the start of 2025 when I earlier reviewed the longer term charts. It is a multi-year 2012 to 2024 very large reverse head and shoulders bottom for bright red neckline on my chart, currently at 277 even. The break higher over this neckline reached its primary target on the upside, but there was a secondary harder to reach, much harder to reach, target up in the 433.35 area. What was interesting about this secondary target was that nearby to that up higher level was the next 100% projected Fibonacci line here at 433.75. Quite close in the scheme of things. Now prices did indeed turn lower up at this key combination of the 100% projected Fibonacci line and a target of 433.35, dropping down through and closing below the important 50% projected Fibonacci line at 347.20 and below the high of May 2011 at 308.90. However, in July and again in August, the market started to form a base on top of the bright red neckline. August, with its monthly key reversal up, raced all the way upwards, and we saw an extension to that move higher in early September, but not reaching quite as high as we saw back in February, before dropping lower again and setting up September as a monthly bearish harami. However, since then, prices have not carried on low, indeed started to move higher instead, at least the closes have, though the monthly highs have still been lower. We had a combined bearish piercing line pattern and bullish double in October, and November's close was sort of followed on through higher, though not in any spectacular way. Now we have congestion just below between 371.25 to 375.75, or roughly where we are now. I've also a quite steep action, especially for a bullish shift pitch hawk for the October 23 to August 25 move. Here we are at this month underneath the middle time, currently at 395.55. As I said last week, I do not favor this pattern much, but it is nevertheless still there. Meanwhile, on the downside, well, the real key will be the bright red neckline below. However, the old 50% projected Fibonacci line at 347.20 also looks interesting. Now, I should point out one more final feature on this longer term chart. The possibility that we may form a very large bullish halfway hesitation or a possible bearish double top, with all the contrary implications both these patterns may have. Now, I will not discuss this last point any further at this time, as it's way too early on this sort of monthly chart to isolate which will be which. But in all this, I ask you, please remember, these here on this monthly chart are longer term, in some cases very long term patterns to look at. London Coffee. 29 weeks ago, I said of the bearish pressure in this market, and I quote, "They now have the overhang of the market from roughly 5,300 up to the year's high at 58.49 sitting above," end of quote. This overhang of bearish pressure and ammunition is important, as it started back then to press down, heightening the brakes lower. Now, the reactionary rise since early August pushed up through some significant levels, now turned into supports, and more so, these are some very keen ones at the time and relatively close to the market supports. Notably is the trio below of the interesting 50% Fibonacci lines, from November 21 to February 25 move at 38.08, the May 21 to February 25 move at 36.49, the March 20 and to February 25 move at 34.81. Then there is the congestion of the 61.8% Fibonacci lines at 41.68, 41.87 and 42.90. Once again, this last one once again features as a resistance. Thus, most of these are now back to being supports, as is especially the rising mauve medium moving average, currently at 42.20. Now, if we look higher, we have some former supports that are now once again resistances, notably the gradually dipping gold long moving average, which is currently at 45.21, which eroded a lot of the bullish incentive back in late August, mid-September, late October, and especially early to mid-November. Plus, 2 weeks ago, this move lower, 2 to 3 weeks ago, saw concerted attempts lower, though the lows seem to be getting higher, usually seen as indicative of some bullish pressures underneath. However, for all these efforts, one has to give credit to the most important of all the resistances, which was, and still is, the capping dark blue February to date downtrend, currently at 45.54. This has caused a number of lower highs, even when it was penetrated, as we saw in October and November. Thus, I cannot overstate the importance of this downtrend. I should also mention something else, and this time was interesting and proved to be crucial, and that was the lesser Fibonacci line at 48.22. This capped the rises in November, in late October, September, and I suppose also in August. All these capping actions initially prompted me to ultimately draw 2 weeks ago a very shallow bright red late August to late October bearish shift pitchfork. The market today is now testing, as it did in mid-November, the bright red middle time below, and that's currently at 42.99. Last week, and I said, and I quote, "I don't like this bright red pitchfork, but it does encompass the recent market structures," end of quote. And so it does, though I would still prioritize the dark blue downtrend above and the rising mauve medium moving average. That's below.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.